The S&P 500 hit 7,000 Wednesday, then immediately retreated. Gold collapsed from $5,000. Microsoft fell 10% despite beating earnings. These are not random events. They reveal a market caught between euphoria and exhaustion, creating exploitable patterns for those who understand human psychology. When markets breach psychological milestones like 7,000 on the S&P, participants experience a dopamine surge. But the inability to hold that level exposes the fragility beneath. This is classic exhaustion disguised as strength. The nomination of Kevin Warsh as Fed Chair Friday triggered immediate recalibration, not of economic forecasts, but of emotional positioning. Humans despise uncertainty more than actual loss, and Warsh represents a shift from the comfortable monetary policy narrative markets had embraced. The violent precious metals collapse demonstrates how crowded trades become psychological traps. Chinese speculators who piled into gold and silver above $5,000 and $100 respectively were not making investment decisions. They were following momentum, the herd instinct evolution wired into human brains for savanna survival, but which destroys capital in markets. When the exit door narrowed, panic selling became self-reinforcing. This psychological chaos created observable system patterns across asset classes. The SP's failure to hold 7,000 represents technical rejection at a significant level, historically preceding consolidation or reversal. The Nasdaq fell over 1% Friday while the Dow dropped only 0.4%, signaling rotation away from growth and technology. This is not noise, it is systematic reallocation. Bond markets responded decisively to the Warsh nomination. Treasury yields rose and the dollar strengthened as traders priced in a more hawkish Fed trajectory, despite Warsh's recent alignment with Trump's preference for lower rates. This disconnect reveals that bond traders trust institutional incentives over political rhetoric. The precious metals collapse from record highs represents a liquidity event, not fundamental reassessment. When silver posts its largest single-day drop on record, this is margin calls and forced deleveraging propagating through interconnected positions. Industrial metals following precious metals lower Monday indicates contagion across commodity complexes. The AI trade showed fractures. Microsoft's decline on cloud growth concerns, Nvidia's stalled OpenAI investment, and memory chipmaker weakness all point to profit-taking in the market's most crowded sector. Yet the S&P still closed January positive, demonstrating that breadth has improved even as leadership narrows. Earnings season data supports continued corporate health, 75% beat on earnings, 65% on revenue. But the market's reaction function has changed. Beats no longer guarantee upside, as Microsoft and Apple demonstrated. This is multiple compression in real time, where future expectations matter more than current results. The VIX remaining subdued despite elevated volatility in individual names indicates light index-level hedging, a condition that amplifies moves when positioning shifts. The Stoic approach recognizes that regime changes create opportunity precisely because they force repricing of embedded assumptions. Warsh's nomination matters not because of what he will do, but because it introduces new outcome distributions. Markets hate this initially, then adapt. The collapse in crowded trades is not crisis, it is a clearing mechanism. Leverage that worked in trending environments becomes toxic when volatility expands. The market enforces discipline on those who outsourced risk management to momentum. This environment rewards flexibility over conviction, diversification over concentration, and process over prediction. Volatility has shifted from suppressed to selective, appearing in individual names and sectors rather than broad indices. This creates false comfort. The VIX can remain low while concentrated portfolios experience significant drawdowns. The market will oscillate between milestone chasing and fear-driven repricing until a catalyst forces resolution. That catalyst could be Friday's jobs report, further earnings disappointments, or geopolitical escalation. The specific trigger matters less than recognizing the system is primed for larger moves. Anti-fragility means maintaining exposure to asymmetric opportunities while ensuring no single position can inflict permanent damage. The market does not care about your narrative, it cares about supply, demand, positioning, and liquidity. Those forces are currently in flux, creating equal measures of risk and opportunity. Control resides in process, not outcome. The crowd reacts emotionally, we remain disciplined. If you value systematic thinking over emotional noise, subscribe for objective market analysis. Download the complete Stoic Exploiter framework in the description. It covers the full human system action methodology for exploiting predictable market irrationality.